Welcome to Investment 360 in the hot seat this evening. Stefano Marani from Clade Asset Management. Stefano, thanks very much for your time.
Good evening.
We're talking about the Clade Global Absolute Fund. You diversified across asset classes, across geographies. Where particular in that diversification do you deem the hotspots to be? And let's start from a geographical perspective.
All right. We obviously change our views as the market changes. We review the portfolio very regularly. But obviously the hot topic right now is Greece. Obviously, good result yesterday in Greece. That's brought all of the mavericks into the market. It's a risk-on trade, and things are really rallying. Now, there are a few factors that confluence into what we're seeing right now. But right now, our biggest tip is the United States.
To actually be in the United States.
Correct.
One of the problems, though, that one has is that in terms of assets, you've got on-cash bonds or treasuries there.
Yes.
You've effectively got negative real yields. In fact, that's the problem really across the world, not really just in the US, but in Europe and even in South Africa, where some of the yields have dipped below inflation. How does that affect the way you actually manage your portfolio?
All right. Firstly, I couldn't agree with you more.
Yeah.
But that's part and parcel of why we've put this trade on. If you look at where things are at the moment, yes, I agree with you. The fact of the matter is that the Western world is so indebted right now that you're sitting in a position where they now have to start inflating their way out of this.
Right.
And at least that's also what the managers are saying. You also have this position where you've got all of the funds pumping liquidity into the system because they missed the rally in 2009. They don't want to miss it again. And the third position is that you've got the central banks flooding the market with liquidity. And right now, if you have to look at all of the different economies, the only one whose data is probably a little less worse out of a really bad bunch is the United States. So even though their bonds are bad,
you have to agree. I mean, Chris, are you seeing that traction in the US, or do you not trust the traction?
I've seen over the last few years strength in the US just to fade out, needing more quantitative easing or whatever to get it going again. So I'm not entirely sure if I'm fully confident of the stamina of the US recovery.
But you're saying more money is going to be put into the pot.
From a macro perspective, I don't believe the story.
Right.
But the fact of the matter is that it's very difficult to go against the market in the short term. That's a very expensive trade to try and put on.
No, exactly.
So right now what we're doing is that, whenever we see the opportunity, we go for that little lollipop. And then the minute that we see volatility start to increase, we take a step back.
Pull back.
Yep.
How do you manage risk? And this is an interesting one because I think risk has become unhinged, especially with negative real rates on what we normally see as defensive assets of cash and bonds. And when you've got default risk now rising on the bonds and also debasement risk rising on cash, the risk story, the way we've traditionally managed risk has become a little bit unhinged.
That's right. I mean, everyone read the book by Taleb, The Black Swan, and I think 2008 proved it true. How we look at it, there are a few factors. Firstly, diversification. That's the one level.
Right.
And we make sure that we diversify across firstly asset classes, and then within those asset classes we keep diversification. So that's the one important area. The second important area is strong quantitative analysis. And then the third area is strong qualitative analysis. And the quantitative is quite easy. We've developed in-house models. We review those models on a weekly basis. And the qualitative is honestly a daily basis of quite stern debate amongst the investment committee.
We've just had your stats up from a performance perspective. And if we look at your performance in rands over the last 12 months, you're up 7.83%.
Yes, that's right. Last year was a particularly difficult year, I think, for a number of people. If you compare us to the general market, I know that MSCI in dollar terms was down about 5%. That was on the all-world index. You had the hedge fund index, who were meant to be absolute return. They were down close to 9%.
Yeah.
So I think we did relatively well with
good outperformance against your benchmarks.
Absolutely.
Yeah.
And since inception, we've managed to deliver 45% in rands, which is
right.
And that's over a 5.5-year period.
That's right.
2006. Chris?
Yeah, I think where, in terms of challenge, how I would interpret it, that the critical thing when one's looking in this kind of environment the first thing is solvency. I know some managers use the term quality, and then yield and growth. Those three, when you've got recessionary conditions and the yield is, promised to be low until 2014 and all the rest of it. What is your focus to actually generate returns and also protect the portfolio at the same time?
Yeah. So when I was here last time, we were speaking about another portfolio. That portfolio, the way that it's managed, lies at the heart of everything that we do, and our philosophy there is cash is king.
Yes.
So cash is king across everything. Everything that we look at, we need to see where the actual cash flow, where the returns are going to come from.
Right.
So when it comes to that, that's obviously one criteria. The other, again, diversification. You've got to make sure that you've got negatively correlated assets in the portfolio to make sure that there is.
What is your cash exposure in this portfolio?
Right now, it's relatively high. We've got about 20% in money markets, and that earns a relatively low yield. We've got cash sitting on the sidelines, which we're waiting to deploy. That's probably around another 10 to 15%. And then we've got the anti-play, the anti-correlation play, which is US inflation bonds. And those are there specifically because we believe in the long-term inflation story.
Right. In other words, you believe it's up, or?
We believe that inflation is going to increase.
They're going to inflate their way out of debt, in other words.
They have to.
The whole world is.
I wouldn't go so far as the whole world. I mean, the emerging markets aren't particularly
I mean, the whole developed world.
That's right.
So
that's right.
Europe is going to do exactly the same thing.
Yeah,
well,
it has
I
to.
think there's very little choice, or default their way, one of the two.
Yeah, but that's a very messy scenario that I don't think anyone could.
Well, I think we've already into the soft default areas.
That just debate would take us all night.
Yeah.
Where in South Africa are you exposed?
We're in South Africa, in our local funds. In this fund, we only get into South Africa every now and again through the MSCI Emerging Market Index, but that's it.
No direct exposure
Absolutely
at all?
No
none.
direct exposure.
And that's because a lot of our investors tend to be private investors who are looking to invest in the long term, and they want to try and diversify their investment from their local holdings.
Yeah. You say your bet at the moment is effectively the US. How do you see the developed world emerging market divide? Is there still value in that?
In the longer term, yes, absolutely. I do believe that there is going to be more growth being driven out of the emerging markets. In the same breath, I will also caveat that as everyone is predicting there is a bubble in China, the question is what happens with that bubble? Does it simply deflate or does it burst? Yeah. So that's one that we're keeping an eye on. But I do believe that the majority of the growth is going to be driven out of the emerging markets. And you look at Turkey. Turkey is now almost a G10 economy. Yeah. Brazil is enormous. Russia is growing. These economies are becoming powerhouses, and they're clubbing together.
They certainly have overtaken the G7.
We've run out of time. We're going to have to leave it there. Stefano, pleasure having you on the show. Thank you very much for your time. Stefano Marani from Clade Asset Management.